Bitcoin's in a very important spot. Along with that, we have CPI and the midterm elections coming up, which will definitely shake up the market a bit. Let's dive into the charts, discuss those, and figure out exactly what's going to happen next. Okay, MegaWhale team, welcome back to the channel. I hope you're all having a great day. We're going to go ahead and take a look at three things today. Number one is the Bitcoin price action on the macro and the short-term time frame. Number two is the midterm elections, how that's going to impact the market. And the third and final one is, of course, CPI, which is probably the most important one here that we're going to be taking a look at the end of the video. Before we get into it, head down to the pinned comments, click the links, join our Telegram channel, you'll find access in the pinned comments down below. Get updates to all our videos, analysis charts, more information throughout the day. And of course, smash the like, subscribe button, and comment down below if you've got any questions. All of that helps support the channel, supports me, and helps me get this content to more people. Let's get into it, guys. So we'll start with the Bitcoin price action. And of course, if you did watch the day before yesterday, watch the video, then you would notice this chart. And for those who are new to the channel, this chart is some sort of, or I'm not going to say it's a full fractal, but it's a degree of a fractal in comparison to 2018, the absolute bottom, and the current date. And we're using the 50 EMA. We're also using the 4, the 15, the 17, 22, 26, 28, and 32 EMA, which are those blue lines, and 50 being that red line, to show us kind of how the price is expanding and compressing between these moving averages as it's pushing sideways. And as you can see over here, guys, we have this expansion over here, these bigger lines, this compression, this expansion and compression. Finally, we have a breakout of the 50 EMA, but this was in fact a fake out. And we were talking about this in the day before yesterday. We said, you know what? I don't think we're going to break out here. I think this is going to be a fake out. We're going to see something like we saw in 2018, and we're going to pump above this 50 EMA. A lot of people are going to jump into the market too soon, or should I say at the wrong time, more likely, and then they're going to get liquidated, or they're going to end up losing. And this is exactly what has happened, guys. It looks like that 2-day candle has printed a red, just like we saw in 2018, above the 50 EMA, and it's coming down. The question is now, how long will we go down for? Will the rest of this pattern play out, or will Bitcoin do something different? Now, of course, if you've been following me, you would have bought $18,000. You have significant profit, nothing to worry about right now. We do have our stop loss back at around an entry point, so we'll analyze it as we go. But the market is nowhere near in the clear yet. Of course, I do believe the bottom is in. I believe that for a very, very long time, okay? If you've been following me, you would know I've been calling that since November 2021, 18K bottom. But there's objectively not enough data in terms of trend strength, okay, in terms of momentum to confirm the fact the bottom is in, and there's still a risk we go down. We'll talk about that today, and CPI or the midterms could be a trigger for that next move down, or potentially even a trigger for the next move up. But short-term Bitcoin, let's take a look what's happening. So we saw that break upwards. We did get rejected at that 50 SMA. We came back down, and we're retesting now this major horizontal zone, which we actually have now developed into a support, which is sitting around 20,840 to this weaker upper resistance, which is around 20,930. Now, will this zone hold? We'll get into that in a second. The question is, where will we go if we do hold, and where will we go if we don't hold? And we'll kind of talk about if we're going to in a second. So if we do not hold this level, we can expect the price to short term move down to these next targets, which are sitting around 20,500 and 20,272. This is the major horizontal support zone for Bitcoin right now, okay? So this is a zone we do need to hold if we do want to see any continuation upwards. If we lose this level, we can see this level being a major support over here. Again here, resistance. There's a major point of resistance and now potentially a zone of support, okay? If we do lose this level here, we are destined to see 19,800 again. And as you have seen in the charts before this, every time we retest 19,800 from the top side, guys, we do actually end up coming back down within the range between 18,700, okay, and this upper range, 19,500. So this range over here. So it is not looking amazing for Bitcoin here if we do head any lower. I would like to say this is the area of which we do need to find support at. We do need to bounce at this level to look healthy again, and ideally if we do want to see an uptrend continue, we would need to hold above 20,500 to 20,272 Otherwise, we're going to continue lower and aggressively lower. Now, obviously, there are a few triggers that can cause that. CPI midterms. It doesn't matter what the price is looking like. It doesn't matter what the technicals are looking like. External triggers such as midterm and CPI can shift the market in a direction of which we cannot predict based on technicals and market structures alone. So we do have to be aware of that. We'll talk about that at the end of the video and talk about exactly what data we expect to be released that would have impacts on the price in certain directions, so we can actually position ourselves before and after to capitalize on whatever actually occurs. To the upside, guys, very, very straightforward stuff. We do need to see that second two-day close above this 50 EMA here, okay? Similar to what we saw over here. We need a single, there's a 1, and there's a 2, two singular two-day closes above that 50 EMA to confirm that we have flipped that 50 EMA. And what does that tell us? Well, it tells us there's positive strength in the trend, okay? It doesn't tell us we're going up, but it gives us a good glimmer of information. It says, look, the trend is now positive in comparison to what has been during this period where we're below the 50 EMA, because the EMAs tell us they gauge the strength of the trend. If we're below EMAs, it tells us we're in a downtrend, we're negative. If we're above the EMAs, it tells us we're positive, we're in an uptrend. Now, if we take that information and we use a momentum analysis, such as a weekly RSI, which we'll get to later in the video, and we have positive momentum, we have positive strength in a trend, we're entering a low volume range, where is the price going to go naturally? More likely upwards. So we're waiting for that a second two-day candle close above the 50 EMA before we look for any swing high. Now, where will a swing high take us? A swing high will take us up to 22,500, okay, which is a very obvious rejection point over here. We're seeing that act as a resistance, numerous times. We can even extend this line backwards if we really please to, and you can even see it acting as a resistance, as far back as over here, which is all the way back in June before we even reached the bottom, which was this point over here. We've seen it act as a resistance and support numerous times. So that would be the most obvious target. Breaking through there, we do have that next resistance at 23,800. Now, 23,800 is a macro resistance. This is probably one of the most significant resistances we do need to break above for the short term for Bitcoin. The reason being because this does actually indicate that upper resistance level we actually challenged and rejected from for about 15 days in December 2020 before we saw that explosive move upwards. So if we go ahead and take a look at the current price action, we can see that that is actually the major resistance point we need to break before we have this entire range here to clear. And this entire range here to clear is a very easy range to clear. And we're going to show you exactly why. If we go ahead and bring up the VRPV, okay, the visible range volume profile, and we go ahead and just adjust it to about 200, okay, on a row size, just so we get a more zoomed in view of it, we can see something really interesting. And that is historical trading volume within this range is incredibly low. What does that mean? It means this is an area, this particular range here is an area of significantly lower resistance historically compared to areas such as here, which was struggled in for a long period of time, or even here, which was struggled in. If we go up, even here, which was struggled in. This area is an area of low resistance, and generally in areas of low resistance, we see more volatile price action, as we don't need to see as much volume for the price to move. Okay, so we can actually push through this level here even with relatively low volume and actually continue upwards. So this is that major trigger. Now, breaking through this doesn't mean we're out of the bear market. Okay, it doesn't mean we're out of the bear market, but what it will do, it will absolutely confirm without a doubt that the bottom was in fact here, and it is confirmed and is in, and there's no way we're going lower, in my opinion. Okay, I don't think we'll go lower if that occurs. Now, there are reasons for us to believe to why we will not push this high, and of course CPI being one of them. If we do break through these triggers to the downside, guys, it's not looking very good for Bitcoin again. Like we just mentioned, these horizontal support ranges, they do need a hold. If we do break through these, it won't look very good for Bitcoin. More importantly, guys, if we lose 18,400 on the downside, say for example, this downward price action does play out, we lose 18,400, we will see a retest of 17,600, which is our absolute bottom. I do not think that if we do retest the absolute bottom again, I do not think it will hold. I don't think we're going to see a double bottom. A lot of people are hoping to see a double bottom. I do not think we'll see a double bottom. I don't think it will hold. If we flip the chart, we can see how extremely bullish that would look. In fact, if we do actually come back up here, it would look absurd. I don't think it's going to happen. Again, flipping the chart over here, guys, we can see a few things over here. It does look like we've broken out of this major horizontal range over here. Let me just go ahead and draw this out. There's major horizontal range. We've broken down, we've coming up, we're retesting it currently. We could reject and head back downwards towards this range here. Or again, if we push back into this range, this whole area could be considered a fake out. Again, so much to talk about, guys. The chart is really, really complicated right now. There is a lot to talk about. And this is the best way to understand it. It's to break down horizontal levels, break down your zones, understand which zones have the highest historical volume, which zones have the highest historical resistance and least resistance, and then play your ranges, trade your ranges, because CPI and midterm is going to throw a spanner in the works. It is going to shift the price action potentially to a degree that is not foreseen, not able to be predicted, and we can't really know what's going to happen in the next 2 or 3 days of Bitcoin if we go ahead and account for CPI and we account for the midterms. What we can say for sure on the charts right now is we can say we are looking bullish. We are looking good on the short term. On the macro, we are looking decent. We're not looking amazing on the macro. We are looking decent on the macro because of this chart over here. Also because of the total cryptocurrency market cap rejecting. If the total cryptocurrency market cap does break through here, we look incredibly bullish. We look incredibly bullish, guys. Okay. So that is about it for the upside. Actually, let's go ahead and talk about the downside. We've talked about the downside a little bit more, but let's go to macro downside. So if we do actually end up breaking through this 17,600 bottom, let's say, for example, CPI comes out horrible, midterm elections is bad, we're seeing another crash. Where could Bitcoin go? We've been saying this for a very long time. We've been saying it since, geez, it would have been the start of 2021 or maybe May 2021. We've said, you know, worst case scenario, Bitcoin says about 11 to 13,000. 11 to 13,000 around this level over here. Okay, that is a worst case scenario. I do not think Bitcoin would ever go lower than that. I don't think it's going to happen. I know some people are saying 3,000. I've already talked about that many times. Don't think it's going to happen. Look, it's possible. Everything's possible, but it's incredibly unlikely. The scenario is right now, we are bullish. We have bottomed. The bottom is into it, has proven not to be anything else right now is speculative. Okay, it is speculative to assume major support will break prior to it breaking. That is complete speculation. It is just as speculative to say the upper resistance at $670,000 was going to break and we were going to go to $400,000 before it happened. All right, people who speculate extremes end up getting the worst end of the stick. They get wrecked because they're taking a massive risk. They're putting all of their eggs in one basket and they're hoping for that scenario to play out. When it doesn't play out, they do not have a backup plan. They don't have a backup plan. They don't have a plan B. They don't understand what to do. They're confused. They're delirious. They're stuck. They're literally stuck. So right now, stick to the charts. Understand the next major safe buying zone for Bitcoin is above this level. Until then, small accumulation on the second 2-day candle close above that Brave New Coin Liquidx 50 EMA on the 2-day chart. Okay. And of course, if you've been following me already, you would have bought literally at the bottom. We literally caught this candle on the day we said the bottom was in. 18th of June, we caught that candle. So you're doing great if you did that. But anyway, what can throw a spanner in the works for a market? And let's go ahead and get into that. Before we get into that, let's just take a look at the overall market and then we'll go ahead and talk about CPI and midterms. Looking for an honest, reliable, and accurate exchange that you can trust to trade on, go ahead and sign up to Bitget with the link down below and join myself and all of our other VIP members and other members who trade on Bitget daily. There's a whole range of benefits and features you can actually get by trading on Bitget. These include no government regulations, meaning you can sign up from anywhere in the world. There's no KYC, 0% trading fees on spot, massively reduced trading fees on futures. It's one of the lowest in the game. And most importantly, access to their protection fund in case the exchange gets hacked. You can actually get reimbursed for your funds so you can ensure your funds are safe. Now, most importantly, if you do sign up with the link down below, that first link, you'll get access to 2 additional features. These include access to a reward center where you can get up to $4,163 in rewards and access to the MegaWhale exclusive referral link, bonus discounts. Every other month we do bonus campaigns. We get up to 10% off your trading fees, or even you get a percentage of your trading fees refunded to your account as USDT. Essentially, you get paid to be on the exchange. That's enough, guys. We'll get back into the video. Okay, so the overall market, total cryptocurrency market cap, we've already talked about it already. DXY is looking okay here. Again, the DXY is one of those things that is heavily influenced by economic data. So we got midterms, we've got CPI. Both of these things are going to heavily influence how the DXY moves. And of course, we know the DXY is the representation of the strength of the US dollar, and we see that fluctuations on the chart. Now, we know when the DXY rises, Bitcoin and risk assets such as stocks generally fall as money moves out of risk assets into currency, into cash, and vice versa. When DXY drops, we're seeing the flow of money as representing the flow of money out of US dollars and into assets. So that is why, when we're seeing this crash over here in the DXY, we're seeing Bitcoin move back up. We see these rises on the DXY, we see Bitcoin generally move down. It's inversely correlated. So what do we see on the DXY now? We're not seeing anything too amazing. We're below these major support levels over here. We still have 113 major resistance. This is the major resistance that DXY will have to break. If DXY does break this, the traditional markets as well as cryptocurrency will automatically start to look incredibly bearish on the macro. Until then, we're looking pretty decent. On the flip side, guys, 109.29, if we break this, DXY will head downwards and Bitcoin and cryptocurrency and stocks will start to look incredibly macro bullish. As you can see, we're kind of in the lower end of this range at the moment, heading more towards that downside. So keeping an eye on that's really, really important. This is the Dow Jones. We can see that we did come down and actually retest after we rejected this level here. Like we said, we came down, we retested this level exactly as predicted again, and we are bouncing from this level. It'd be very interesting to see what happens here. Again, we will need this price action to push upwards and actually clear this local high to see any sort of continuation. So do not get too trigger happy too soon. We do need to see that high clear before we have any confirmation of a continuation upwards. Where will a continuation upwards take us? Very obvious stuff, guys. 34,000 right over here at this level upwards. Okay, very, very obvious. S&P 500 looking not as good as the Dow Jones over here. We have bounced this horizontal, this diagonal trend line again. Not looking too strong, rejecting from this point. Again, we will need to be clearing these levels and potentially clearing these levels to see any positive macro shift in the direction. Until then, not looking amazing. 10-year and 2-year government bonds, again, we saw these crazy wicks to the top side and it looks like it's continuing downwards. 10-year again, we're still in this massive ascending channel. It will have to break to the downside at some point. If this does break to the downside, guys, stocks and cryptocurrency, they go up, okay? So, we are extended here. This has been pushing sideways. A good thing or a signal that this potentially are breaking down is this over here. Generally, when we see our third peak not reach the top of the trend, we generally see a weakening in that trend, and it does suggest that we are close to be breaking down. It's very, very unlikely we see another peak back up to the top of this trend line. It is more likely that the next major directional move is going to be towards the downside. So again, indicating we are potentially bottomed out. That is about it for that, guys. Let's go ahead and talk about the CPI. So CPI, we do have two things we want to look at, and of course this is coming on what was the 10th of November, 8:30 a.m. so it's like 3 days or something. It is 12:16 p.m. here in Australia right now on the 7th, so you do the math. October, that is going to be the October data. We have two things we're looking at, and we're looking at the core CPI and we're looking at the just standard CPI, okay? And of course, these numbers are really, really important because they reflect what the inflation is what the inflation rate is in the economy. We already know the correlation between inflation and interest rates. So we know that inflation kind of dictates what interest rates will be, and interest rates shift the systematic risk in a market, which actually directly influences prices of risk assets. So it is very important because it's almost like a leading indicator in regards to what they're going to do with interest rates, or how aggressive they're going to be with interest rates. So of course, right over here, just taking a look, the core CPI, guys, core CPI, it excludes food and energy. So it's everything excluding food and energy, and just a standard CPI over here year on year, it includes food and energy, okay? So what we're looking at for CPI over here, year on year, it is forecasted to be around 8, the previous was 8.2. Anything under forecasted is automatically going to be bullish, okay? Anything under forecasted is automatically going to be bullish. Anything at or above forecasted is generally going to be bearish. Anything massively above previous is horribly bearish. All right, so we're looking for anything below forecasted to be great, a good sign. Anything at forecasted is generally going to be bad, because the reason it's bad is because it's generally usually the perceived systematic risk usually prices the forecasted in. And we'll talk about that later, because a lot of people are like, oh, you can't price CPI in. You can actually price CPI in. The reason being is because CPI doesn't directly influence what the asset prices are going to do. CPI tells us what interest rates are going to potentially be like, and then interest rates is what influences asset prices. So if CPI comes out at forecasted, we're generally more likely to have priced in that expected move for what interest rates are going to be, and therefore the move generally happens towards the downside. So I hope that made sense. I'll kind of clarify it in a second, in a little bit again. But really simple, guys. Under forecasted, great. Forecasted, not so great. Above previous, very bearish. Okay, and the forecasted is 8 and previous is 8.2. Same thing for CPI year on year. This is the core. Same thing, 6.5, guys. We're looking for anything under 6.5 would be really, really good. Anything at 6.5 or over, not so good. And anything over 6.6, pretty freaking bad. Okay, pretty bad. So that is what CPI is. Now, how does CPI influence asset prices? So we've talked a lot about that now. Let's go ahead and take a look at this chart. So there are two charts I want to show you. Bit of a mess, but we'll explain it. So we have CPI over here, and obviously PPI, this is Producer Price Index, we'll kind of ignore that for now. We have CPI. So CPI tells us what inflation is. It tells us the rate of inflation in the economy, and based on the inflation rate, we adjust interest rates, okay? Interest rates are designed to counteract inflation, or to bring inflation down, to fight inflation, like they've been saying. We're raising interest rates to fight inflation and all that kind of crap, okay? So very important we understand that correlation. So it's not that CPI actually changes asset prices. It's that CPI tells us what inflation is, and then based on what the inflation is, we can understand how they're going to change interest rates, which would then impact everything else, all right? Now, interest rates are really important, because interest rates change the interest that people pay on their debt, okay? And we already know whether you're a company or whether you're an individual, a household, you will most likely have some degree of debt, okay? Whether you're a household, you have a mortgage, you have short-term loans, car loans, whatever, or you're a company, you've taken a shitload of debt on in low interest periods of times to pay for assets, to acquire assets such as stocks, such as cryptocurrencies, such as properties, whatever it's been, to increase your cash flows to make your company look more favorable, okay? Generally, when interest rates rise, your interest repayments increase. The amount of cash that you have to pay increases. What does that do to assets? Well, if more people are paying cash, people need to have more cash, therefore they move money out of assets into the dollar, DXY rises, asset prices fall, all right? It is really as simple as that. And I could talk for hours about this, we do a lot of information, we talk about this a lot, but I'm not going to bore you guys today with it. It is really as simple as that. So when we see the CPI come in lower than expected, what does that tell us? Well, it tells us interest rates are doing their job, and then we are more likely to have next interest rate hike to be of a lesser significance or degree than the prior, okay? So if interest rates have been around 0.75 and inflation comes out very, very positive, very under that expected, okay, it's more likely you're gonna do a 0.5 or even a 0.25, and that is positive because it starts to reduce the increases, the incremental increases on inflation, on our interest rates, and gets us closer and closer to a pivot to where interest on debt starts to change, okay? People start investing more money, people start taking more loans again, and prices of their assets start to rise. So very important to understand that. Now, all right, guys, there's one more thing we want to talk about, and that is the midterm elections. Now, I've had a lot of questions about the midterm elections. People ask me, Whale, will the price drop? Whale, are we going to go to the moon? Whale, what's going to happen, and what do you think is going to happen? And I guess I don't really think about the midterms too much, and I haven't really put a lot of thought into it, because as a trader, I don't really care what the price does. I know this is going to sound stupid to maybe some of the investors on this channel, but as a trader, I can capitalize on any market direction. It doesn't matter to me whether we go up, whether we go down, whether we bottom, when we go to a bear market for longer. It doesn't really matter to me. I trade any direction. Now, when it comes to data such as CPI, when it comes to data such as interest rates, I do trade those news events. The reason being is because we have tangible, real data to actually trade based on. And we know how that data, those numbers, those rates, directly influence the market based on directly influencing the systematic risk and how that influences asset prices and how that can change cognitive biases and psychological biases in terms of where the price will be going, okay? But it also changes the actual risk in the market, and that influences the price too. So we have tangible, real world data and real theories and real examples, and we know how things work when it comes to that. When it comes to midterm elections, we don't really have the same degree of data, at least what I know at least. We just have speculation. We have speculation that if a certain party gets elected, they're going to make certain adjustments and then the price is going to go a certain way. But that isn't data. We can't trade off that. As a trader, as an objective analysis, as someone who trades based on data and fact, I cannot bring myself to trade or even make a speculation based on the midterms. What I can say is, I don't think it's a great time to be front running the midterms. I don't think you should have an opinion based on the midterms. I think the best thing to do is to allow it to occur, see the reaction, and then make a decision. Don't jump in too early. Don't expect anything big. Allow it to occur and make a reaction. Simple as that, guys. I'm going to leave it there. Now, really quickly, we have seen a lot of negative price action in the past from midterms. We saw a significant drop in 2018, about 50% crash a few days leading after midterms. That is, of course, on this screen over here from this green line. Will it happen again? I don't think so. I do not think we're going to see a 50% crash. There's a lot of supporting evidence that this is the bottom. It was very different in 2018, guys. This was very clearly a consolidation zone, a sideways compression zone, a massive symmetrical triangle before it crashed downwards. We had this huge support zone we have over here that dated back, we're talking all the way back to the start, midway through the bull market. We're not in that similar phase now, guys. If we're looking back to the market over here, that was around this level. We've already lost that level in terms of the market. We are theoretically closer to this area in terms of structure, in terms of bear market structure, than we are up over here. So to see a 50% crash here and take us all the way to $10,000 or wherever it would take us, it seems very unlikely. Now, of course it is possible. Everything is possible, but it's incredibly unlikely. It's not something I'd be betting on. We are much more likely to heading upwards in the next few weeks or months than we are to be heading into a negative 50% crash like we saw in 2018. That is my opinion. Again, it is speculative. It means nothing. It really doesn't mean anything. Take it with an absolute grain of salt. We don't know what's going to happen. No one knows what's going to happen with the midterms. Just react based on what occurs, okay? We have our data. We know what's going to happen with CPI. We know what we're going to do for CPI. In terms of short-term price action, we have our invalidations, we have our triggers, we have our horizontal zones, we know how to trade those zones, we know where the price is going to go when certain zones break, we know where to accumulate, we know where to sell off, we know absolutely everything right now. We have a grasp of the market, we are playing it perfectly. There is no need to go ahead and gamble everything away based on a piece of information that is completely speculative and we can't control, okay? That being said, guys, I'll see you in tomorrow's video. Have a great day.